We had some Fed information yesterday, and I'm going to kind of back into that in a bit of a circuitous way, but I believe it's kind of the correct way. I had said in the weekend review video that we had hit the low. I had said about 2 videos ago that I thought we would revisit the 87s, and then after that I thought we would come back up to the top of the range, and that actually is what happened here. We actually overshot some of the range. I was using the 199.84 kind of flagpole as the top of the range. We did have a little bit of time that we spent over there on a spike move, but then collapsed after there, and now we're kind of testing back up into there. And today we actually touched, actually slightly over, the 61.8% Fibonacci retracement from the all-time high to the crash low, our recent crash low. So we're kind of at a point where there needs to be some decisions made. And my take was that number one, I think that the reason we were able to propel so high so quickly is that you have a lot of people who don't really know what they're doing. They're traders that were bullish, and they're very used to like the 2013 market where the market was going up every day. There also were accustomed to a more forgiving market in 2014 where we were just going sideways, and you kind of were able to get it back, so to speak. And I don't think they've really fully adjusted or really don't know how to short sell properly. And I was referring to them as kind of training wheel shorts, that they don't really know what they're doing. They're making the same mistake on the downside that they're making on the upside, meaning they're chasing highs. It's amazing. You'll see some of these people, and I don't like to talk. I don't like to give anyone's names in particular, but there are some fairly well-known people who run some quote-unquote respected services, and I really don't understand what people are paying them for because they always seem to get it wrong. But getting it right is very important in my book. We do keep score. So I do believe that the mistake is that they are shorting at the lows. And the short sellers tend to be a little bit more disciplined with regard to stops and how they play their trade setups. They usually have a stop loss set earlier, and I guess people who play long, the public, and for the most part, usually play the hope and pray game. And I think these people are not accustomed to bear market rallies or snapback rallies. They can be quite violent. So I think that a lot of these people were pressing the 190s, the 187s, hoping for 182s, and they didn't really get rewarded the way they thought they would, and a lot of people have been trapped short, and I think that has been part of the power of the move. So that is my theory on why we've gone down and why we've gone up. You've had a lot of people who chase the highs, they get disappointed, they puke, then they reverse and make the same mistake. Even they compound their error by getting short at the lows. Anyhow, where does that leave us now? We are now moved up. We are over the downtrend line, which is quite impressive. We are over the bear flag flagpole, and we just hit the 61.8 Fibonacci retracement. So 201.90 before the move to 213 had been a high for a while in SPY, and now we're kind of revisiting there. We all know the big breakdown in the market was at 204, so the risk reward now for a still higher move into that breakdown begets a little bit diminished. We can still do it. I believe it is very possible, but you might want to be a little bit more careful. I'd be curious now to see how the market can take a pullback, because we are now kind of entering range, a higher range. So there is going to be some responsive people who were long here and who were disappointed and were kind of, these are the kind of people that when the market was 182, they're like, oh my God, just let me get back to even. I promise I'll never do it again. So there'll be a lot of dead bodies that sort of get made whole up into these levels as we're coming up. So there should be some supply that does come in. I know a lot of people technically are going to be looking to short there, so we'll have to see how that plays out if we do wind up getting there. If it happens in a gap, like if we're up into the 204s or 205s on a gap, just short it and use a stop over the high of the day on that opening bar. You'll have very good trade location. I would say that discipline is important, and part of the this week that I've been discussing is that the pullbacks and a lot of the people who have been trying to short and pick the top here haven't been looking at the market internals. The other day before the Fed, I had said that I thought that they're just ignoring price action. I think they can't comprehend how the market really works, and they just sort of think it's too high, or they think it's too low, or they think this and they think that, and they don't look. It would be like crossing the street and not looking both ways. So the other day into the Fed, I had said that the market was coming down, and I did give a short play. I talked about that, and I also gave a cover point. But I said that it wasn't a trending day, and I thought that we were going to wind up seeing that it was bullish. It was consolidating. It was plainly bullish to me that we were moving sideways. You had just come up. You were right at the downtrend line. You were just kind of consolidating there, like the last day or two, and it wound up being higher. And I think that caught a lot of people off guard because they were assuming that assuming incorrectly that the Fed was going to be a problem. Now, what did the Fed say here? Well, wait. Before we get to the Fed, let's play this out. Let's play this out to the fullest. So you had the move then over the value area of the day. If you follow me, I talk about levels that basically the value area is where 70% of the prior day's trade takes place. And I had said on that Fed move, I was really not thinking we were going to get as big of a move on just Fed minutes, but the Fed minutes were so dovish that it wound up becoming a full-on Fed day, and I'll talk about that in a second. I want to just get through the technicals of the move first. So once that high was taken, that was, I guess, where shorts had put their stops, and you had this price void up higher into the upper resistance. Like I said, I'm getting more cautious now as we approach the 202s, the 203s, the 204s, and the 205s, and I will be looking for right or right out shorts into those areas. Just for a rollback. Believe it or not, we can still get up that high and still be in a bear market. This could just be a bigger, wider flag than we realize. I've seen this happen so many times. There can be, you come down, you kind of work your way higher, and then there's a big, follow through lower. And it's still to be determined whether that is going to be the case. If this was just leg one of a 3 to 5 leg move down, I have discussed that I do believe at some point it may not be this time. This time might not be the time, but I do think at some point we are going to retest those 2007 and the 2000 and 2007 peaks down in the 155s and 157s. Whether or not that is going to be this year is maybe not. I mean, I just say take it from level to level, decision to decision, range to range. I've heard it described so many ways. One of the big mistakes I see traders make is that they kind of assume and they take price just because it's going their way to the maximum logical conclusion immediately, and they forget that there are levels in between. Those levels really matter because there are still other people who are looking to buy or to sell there, and you have to take it one point at a time, particularly if you're in options, because you're playing in certain time frames. Anyhow, that is sort of in a nutshell, without getting really too complicated, what is going on here. I hope that made sense. If there are any questions about that, feel free to message me and I will answer those questions. We're going to do a new thing where if I say something on Periscope and there's any ambiguity about that, I'll answer it in the weekend review and vice versa. If there's something in the weekend review that you guys are a little curious about, we'll answer it in Periscope. We're going to kind of marry these up a little bit more. I think that will be the most productive time. So if there's any questions on that, please message me. My DM on Twitter is open, by the way, now to anybody who wants to message me. I don't have to follow you. Also, it's not that I don't want to, it's just that my stream would be very, very cluttered if I followed almost 7,000 people. So just send me a DM if you have a question, and I'll be happy to answer it. And you might even want to put a little mark. This was in a question about the weekend review, or this was a question about the Periscope. Anyhow, that's what happened technically. What happened fundamentally here on the Fed, and this is why the move really got ignited, was that the Fed hit all of the points they needed to, sort of do-re-mi, for a really, really dovish statement. They were concerned about China. They were worried about slowing growth. They mentioned, I think there was something in there about the employment, but the key to the move there, and what really ignited the market, and I think it took a minute because the reaction was not as immediate. I was, saying it very quickly because I was looking for it. You have to know what you're looking for when you go into these when you go into these meetings. And the things that were key were, one, they were concerned about the strong dollar, and the most important was their inflation expectations and the target to inflation. And they don't see it being met until 2018. That is insanity. That means that we could have 2 more years of no interest rate hikes. Believe it or not, as crazy as that sounds, they could maybe not even raise interest rates for about 2 years. So I'll talk about GoPro in single digits in a minute. Well, I'll try and maybe I'll cap that off over there. Anyhow, so this is going to be very controversial, and it's going to be a new position, and I kind of teased this Periscope that I have a new Fed thesis. And the Fed thesis it's really not so much of a new one. If you really pay attention to me and you've watched me and my endless rants about the Fed and what Fed policy was going to be, and by the way, it all happened the way I said it was going to happen, even with tons of people being very, very rude and questioning me and what have you. It wound up working how I said. I said there'd be lower for longer. I said I didn't think that there would be a move until at least the first quarter of 2016. That now seems to be what Fed funds are pricing in. It's about a 50% chance that they raise in March. And I think a lot of that is going to be their data dependent. So what does data dependent mean? It means they've been lowering their GDP estimates. Already they're coming in. We had a very weak year here with regard to growth. It's stall speed at best. The world is not doing well. We all know Asia is weak. And the employment picture is not looking very good. The labor participation rate is low. Yeah, the headline number, it's full employment, rah, rah, rah. Internally, that is a very weak number, and the Fed knows it. And they are going to use, I believe, this target inflation number as their kind of cover to stay lower for longer. Now, if they don't believe they are going to raise, now this is where it's going to get real controversial here. If they don't believe that they can meet their target for inflation until 2018, how do you get there faster? Now, this is going to get really, really wild. I believe, and this is not consensus, that the Fed is going to have to raise their inflation target from 2% to 4%. And they are going to have to do more QE. QE4, baby, it's coming. If they don't do that, they won't be able to reach that until 2 years from now. And I can't really see the Fed wanting to go through 2 years of not meeting their mandate and playing this game back and forth. So I think that they think they want to raise, but what they really want to do is ease. Is that kind of make sense? Like you'll feel like you want a hamburger, but you wind up eating sushi. It's kind of a sleight of hand. And I think the Fed thinks they want to bite the hamburger, but they really want to do more easing. And this would be for a few reasons. One, that the debt number is really high. It would be a very stupid, self-inflicted wound to raise interest rates into a slowdown and pay more on your debt. You're not taking in as much because growth is slowing, meaning tax revenues are lower, and you're raising the amount that you pay out. It would be like spending more on your credit card when you have a job that's paying you less. Like if you were making $100,000 a year and now you're making $70,000 a year, are you more prone to spend more or spend less? The answer is you're going to have to spend less out of necessity. Yes, they are drunken sailors in our government, but the Fed, I would think, is the smarter of the lot. I also think that the reason we've had this weak growth is that the Fed has been the only engine on a very large plane. We all know that we don't have, fiscal policy that is promoting growth policy. You have Obamacare, which is a tax that is going to hit big time in 2016 for corporations. Speaking of which, you have the highest corporate tax rate in the entire world here. That is a big problem. You also have and the Fed, Janet Yellen in her last congressional testimony talked about structural unemployment. She didn't call it that because that is like the monster under the bed for the Fed, because that they can't cure very quickly like they can with cyclical employment. Cyclical just goes with the ebbs and flows of the business cycle. Structural means that the people are, like, for example, people are still building horse and buggies, but we now have automobiles. How many people are building buggy whips and building wheels for, building replacement parts for those horse and carriages? It just doesn't happen. You've had major technological advances in the last few years, particularly with supply chain and supply chain management, inventory management. So companies are running very lean. They don't need as many people. If you look at if you look at a car factory like Ford or GM, they don't need as many hands on the floor to produce cars as they did in the 80s or in the 90s or even just 5 years ago. It's all automated. It's machines. And those machines you don't have to pay unemployment benefits to. You don't have to pay workman's compensation. You don't have to pay 401ks. You don't even have to pay a salary. That is really what the world is coming to. We have a technological advance happening. And the Fed, that is not something the Fed can fix. The only way that can really be fixed is, one, I hate to say this, if you have some kind of crazy jump down in the population like leftover style, or if you re-educate people, and that doesn't just happen overnight. It can take years, even decades. So I think what we are experiencing now, based on the recent unemployment, is you're having kind of the worst case scenario where you have structural unemployment and a cyclical downturn into that structural unemployment, meaning the economy is weakening, growth is softening. We all know what has happened to oil. They have been laying people off left and right. I think it was Cisco who just did a big round of layoffs. HP just did a big round of layoffs. It's just not a pretty scene what's happening. So the Fed knows this. They are, I would hope, very smart people. Some of them maybe not so much because they talk all this smack on television. Anyhow, I believe that the next move for the Fed, if the data keeps coming in poor, this will not happen right away. I'm sure I'm going to be slugging it out with people on the stream over this. I believe that the next move, unless there is a major pickup in growth, and maybe that happens now. You can see commodities are starting to bottom. I called the bottom in oil, roughly around that range. I didn't, when the day Goldman Sachs came out and said $20, I'm like, that's it. That's got to be the end. These are the same geniuses who, when oil was $148, were saying it was going to $250. They are wrong, and they're now these same people it was at $30 and $40, and they're saying it's going to 20. There is something called inflation. There is something called emerging markets growth. The Chinese and Indians are trying to become more like us. They're going into an automotive society. It just makes zero sense that it would go back. I mean, listen, anything is possible in the market with price extremes. I will not say that, there couldn't be some kind of world depression that doesn't bring oil down. But with the current fundamentals that we are dealing with right now, that doesn't make any sense to me. I have said that I thought at some point it's going to get back up to $75. It is not going to be a straight shot. I think all of these stocks, by the way, have run way too much, too fast. The Chevrons, the Exxons. I do think that there's some room up still. Like Exxon could get to 83, believe it or not, rather easily. That area is going to be a major inflection point. You can't really say, I don't think safely, that global growth is in a true upswing unless Exxon, and I've said this for a while, if you go back a few videos a few weeks ago, unless it is over and holding $86. I don't want to get into all the wonkiness and the technicals of it, but believe me, that is the level. If you can get over there, you're going to see a pretty big, I think, uptick, at least in oil and potentially demand for oil, which to me would be the proxy for global growth. Excuse me. If that does not happen and it can't hold above there, then I think we're going to start be talking about QE. And I think that we could kind of shelve this conversation until after the first quarter of next year, because I don't believe that they will consider doing anything until then. I believe that they are off the table for the rest of the year. Of course, there is always some kind of small probability of a policy error and them moving quickly. I call these kind of things like Tim Cook renaming that third or fourth generation iPad. They called it the new iPad rather than the iPad 4. So maybe this is the new Fed. They're going to do their sequel and then the prequel and then the sequel to the prequel and get mucked up. That, to me, would be a huge policy mistake. The market will go down a significantly larger amount. You think it was ugly the other day with that 1,400 points. You ain't seen nothing yet if the Fed raises into a slowing economy. I believe that would be enough to take the market for the next leg lower. But I don't think that's happening. I'm in the camp now, firmly in the camp of QE4. I was waffling a little bit before, but I am in that camp at the moment. I don't really see, like I said, if I'm the first one to say it, and I always want to be right, and the only way to be right is to first stop being wrong. I will be in a position sometimes that day, and I'll flip it out from long, and I'll be short by the close or in the next 10 minutes if anything has happened that makes me think my thesis is wrong. I am not going to dig in. I will flip on a dime and be, raising rates. Let's raise rates. I'll be the first guy out there saying that. I'll be at the pool in the morning with the old people, to get the good seats. Anyhow, that is my theory. Unless I start seeing, what I would need to see for that to happen is a significant drop in the dollar. It is making some lower highs, although it is still in risk of breakout mode. I need to see some growth, some real growth come in with regards to GDP estimates. You don't want to see them coming down. You want to see estimates revised up. They've been revising estimates down. That is not good. They've even been revising real numbers down. That's terrible. And you need to see some real improvement in the labor force, particularly in the participation rate. If I start seeing that moving the right way, then I'm going to start changing my theory. But growth and the inflation target, if they start saying we've met our inflation target, or if you start seeing over 2%, then I might flip and be in the rate hike camp. But if they're not making their inflation targets until 2018, they're not raising rates. In my opinion, they're going to have to narrow. Like, think about this. Let me put it to you like this. I like to draw analogies to things that happen in real life so that they can be relatable. If you're going someplace, like let's say you want to go out to the Hamptons, and the speed limit is 50 miles an hour, it's going to take you, 3 hours to get there. If you want to get there in an hour and a half, you go 100 miles an hour. So what the Fed could do, rather than taking 2 years, whatever, to get themselves to their 2%, is just raise the inflation target and do some QE, and they'll get there faster. They'll kind of bridge that gap. So that's just my theory on that, and that's why I think QE4 would make a lot of sense. All right, let's get into some stocks here. I'm sorry if we got a little too wonky with this stuff. I'm seeing some stuff in the markets here that I like and that I don't like. The silliness stocks, I think at this point, I don't know if anyone wants to contest me anymore. I said they were going to go much lower and make new lows, and they have. I mean, GoPro fell apart, right? That thing is a piece of crap. Yes, I do believe that eventually they are going to see single digits, but I'm more inclined to play long here than short, and I'll explain that to you right now. Let's just lead off with that one, because that embodies so much of what this market is. The stock is still trading 20 times earnings. I'd have to look at their forward multiple. It must be a little bit less. But they came out with a new product. It was at a lower price point. They lowered the price of their more expensive product as well, $100. So their margins are compressing. And they must be doing this because they're not selling better. They're not selling their products as much. So I think that the stock coming down is factoring in the fact that they're going to miss the quarter probably. However, it's come down so much, so fast that, it's entitled to a bounce, I guess. You've had a lot of analysts come out now. These were all people who were rah bullish when the stock was much higher. Morgan Stanley capitulated this week. One of these other firms did as well. these are not, to quote that guy Josh Brown who's on the TV, these are clown grades, not downgrades. These are just people who are they're just stupid. I mean, if you like something that was double and the fundamentals have not just changed, this has been very obvious to most people who have been watching this for a while. This is sort of like, sell the news. This is maybe buy the news at this point. Anyway, I do think at some point, though, that unfortunately that GoPro may be a single-digit stock. I do think that they're not going to make their earnings estimates. I think that there's only so many extreme sports enthusiasts. How many guys are duct taping one of these things and jumping off cliffs or riding their bikes down mountains or, whatever the hell these cockamamie people are doing, videoing their squirrel on a jet ski. I mean, how many people are doing this? I mean, also, what is the replacement cycle of this? They're not subsidized. They're very expensive. Everyone has an iPhone that has cameras. They just made the front-facing camera on the new iPhone even better. It's like 5 megapixels. I was out like last weekend with some friends, and we were clowning around with that thing, taking photos. They were great. The cameras on the smartphones are great. They're always in your pockets. And guess what? You get a subsidy to buy a new one every 2 years. So now you get your rose gold one in a couple of years. Who knows, Maybe it'll actually be rose gold if gold keeps coming down, right? It'll be cheap enough. The phone will actually be made out of gold. No, so I think that the GoPro is going to be, it's sort of a fad product like a Crocs or like a flip camera. If you remember, Cisco bought that for $600 million and then they wound up closing it a year or two later. GoPro probably have a little bit more legs than that because they're standalone. At some point, maybe they get bought or whatever, but I've never believed the social media story about them. If you want social media, buy Google for that. YouTube is such a better product. Buy Facebook if it comes down. That is a better social media product. How about we talk about well, let me just wrap up on that. If you take a look at this other one, the other silliness garbage I've been talking about is that Ambarella. I hated that stock up higher. I didn't like it at 110. I talked about that as the short. And then I said when it broke that neckline at 96, it was a short. And the stock today closed at $57. So you tell me who's the schnook in that one. And I had people calling me all kinds of crazy names on the stream with that. I was not a fan of these companies. They had clearly gotten ahead of themselves. They blew off. This reminded me, and I said it at the time, and everyone told me this time was different. This reminded me just like the 3D printer stocks. Everyone was going to have a drone. You're going to walk your baby with a drone. You're going to have your nanny is going to be a drone. I mean, this is ridiculous talk. These are anyway. Anyway, I don't want to get off on too much of a tangent here, but. Anyway, you can see I'm a little bit fired up, which is rare for me on a Friday, right? I guess I haven't been feeling well the last 2 weeks. Today I feel a little bit more fired up. So that's GoPro. I do believe, though, at this point, it's close enough to the IPO price that I would rather be long here than short. Maybe you get a rally to the breakdown point of 37. That's how I would play it. And you can use that 2707 as a stop. I don't really think it's going to get much below 27 to maybe 25. The short here, I think, is over, at least for now. If it rallied back up, if it got back up to if it did something like bounce 50% and got back up into the 40s, man, I would be all over that thing, laying into it all over again. It would be like Christmas morning all over again. That's my story with GoPro and with these ridiculous stocks. They are bull market stocks, not bear market stocks. Yeah, I like I said, I've sort of declaring some victory with a lot of these. I would not be first shorting them into the weakness here. Yes, they can still go lower, but you don't have good trade location. If you now first woke up and you hate GoPro at $26 or whatever, $27, it to me is just lunacy. So anyway, we were talking about social media stocks, and my favorite one, I think one of my favorite companies in the universe is Facebook. So I had said I thought it would get 100. We got pretty close. We got 99.24. I guess you had some anticipatory sellers, and it's just been kind of in this consolidation pattern sideways. It's losing some stochastic momentum. You do have earnings coming up. So this is going to be a Costanza, in my opinion. If it rallies up hard into the earnings, you're going to probably be better off selling out your long or even taking a short bet, God forbid. If it has some panic and they sell it off ahead of the earnings, then I think it favors being long, and that's how I would play it. We have some more time until it happens. Let's wait. There is not enough premium in those options to play any types of put ratios or short puts. I would say if you want to get long, you could play a put ratio with the intention of getting long, or you could to play a put ratio with the intention of getting long. I would love to see, if I had my druthers, the stock have a little bit of a panicky shake and bake. I love that shake and bake, particularly with stocks like Apple, where they have a sell-off before. Everyone who was bullish gets scared, they sell their shares, and then the stock goes up higher. It's I got that line. It's actually a little homage to Talladega Nights with the Magic Man and El Diablo. So they shake it before they bake it, right? So that's one of my favorite setups and plays, and that's how I would love to play Facebook. If you're long the stock here, and I know a lot of people are, and my theory is it needs to hold over 92.54, let's just say 92.5. I'm willing to concede some slippage to the 50 MA, and I actually like the 50 MA better than that because if you look at the body of first of all, the last 2 days you had a look below the 50 and it closed back up, and then yesterday you did wind up closing below the 92.54 slightly, but the body of the day's action was held the 50 MA. So if you start getting any closes below the 50 MA, then I would say you just kind of maybe take it off or put on some protection. The puts are cheap. I would play it that way. So 50 MA, let's long over 50 MA, or even short if you want to play short for a cutie pie move, maybe a little for the shake and bake below the 50 MA. So 50 MA. Let's just keep it simple, stupid. 50 MA. Twitter. Jack Dorsey is the CEO now, the full time. I mean, imagine how high the stock would have gone if he would have actually done a goatee like me. Stock would be back to 45. Anyway, the guy came in. He's been doing some work. He's been shuffling around. He did these mentions, Project Lightning. I think it's a piece of crap. I don't like the service at all, but I do like that they're going the right way. If you look into the app, you could see that they have areas now to enter your credit card information. I think they're going to have point of purchase where you could make purchases on Twitter. It'll be great for companies who have, first of all, Twitter tends to have more intelligent people, although with some of the trolling I get on there, I sometimes question it. But Twitter does tend to have some of the more intelligent people on there, and I do believe that they would be prone to maybe click and buy. A company can send something out quickly, and then you could buy a special right away. This would be amazing for the Black Fridays and all that stuff to do sales on that with Twitter, and then you could set for mobile notifications. I think there's a lot they're going to do with it. The earnings haven't been the Twitter problem, though. The earnings last quarter were actually really good. If you remember, the stock initially popped. The problem is that no one knows how to use this damn thing, and it's sort of like people tweet on occasion. There's not enough active users, monthly active users, so they need to start attracting more people to the platform, make it simpler. I think they need to make it more Instagram-like, actually, and I think that would be the solution. So the stock is rallying into the quarter, which is not good. I would actually like it down into the quarter so that it could maybe rise on the quarter to play it long. The question here, I don't think they're going to do well with the monthly active users this quarter. So this is going to be the big tell. Will Wall Street look past that, or will they not? And if they don't, the stock's getting cut in half again. If they are willing to look past it, I do think you probably will rally back up somewhere to the 45, 46 level, which is where it really broke down from the first place. So that is that's my theory with Twitter. I'm not really sure how I'm going to. I have a long in Twitter. I set it down by the lows that I thought that I'd rather be involved with this. I have a small long in Twitter. Full disclosure, I don't really particularly love it, but I don't see how the stock could be really any more hated. I mean, everything is going wrong. Everyone knows what's going wrong. So there's really, I think they might get it past this quarter. We'll see. I'm willing to stipulate that a little bit here, although if it keeps rallying into it, they're not going to get any pass. They're going to get the back of the hand. So let's hope that if you're actually bullish on Twitter, you want it to kind of cool its heels here a little bit. You don't want it to blow off into the quarter. So that's Twitter. I think we need to start moving a little bit faster. I'm going a little bit too slowly. I covered this. Oh, yeah, we covered a decent amount of stuff. Tesla, let's go back to the top of the key here. So Tesla today, I'm going to show this more in the weekend review video. I'm going to do like 2 more and then we're going to wrap up. But because we're going over and I have to go meet somebody for a meeting about the subscription service. Shh, I don't talk about that, but it's coming. Anyway, so the Tesla is at a channel low. It's not an extreme channel low, but it is at where I have the channel low drawn. And it was also at a 61.8 Fibonacci retracement. I believe if you want to play long here, I would condone that, and I would say that you could do that with a stop below. Yeah, it's actually not about 5. That's all right. Anything below 215.51, then I think you're going to get to see the 204s, 205s. There was the flash crash low was 195, 191, so you got to be out of there. If you lose the 215s, if you're going to play this like 61.8 area and where I have the channel low, I'm a little cautious though. I said that I was iffy about it being below 242, which is where the secondary was. So anything below there, do keep in mind, is vulnerable. And if you're going to play it here, it's a right or right out type of a play. I do believe this was just a case of the sell the news sort of thing on the Model X. It ran up into that. It ran up into 265s. It actually pushed through there. Excuse me. I had said that area was a sell. I haven't really looked back, actually, and the stock is coming down. So I'm very cautious there. I do believe that the 215.51 was the pullback low after the flash crash low, so that is really where you need to stop if you're sort of in the hope and pray camp, or if you want to play, if you're looking to play here for a bounce. The primary trend I see is roughly around the 207s, and I had said that I thought that the that 204, 205 was roughly around that area. I will be looking to play right or right out. Particularly if it's pre-earnings and if it's like in a straighter line, like if the next couple of days were down right into there, I'll be looking to sell some puts probably below the 190s. I like that area because that's a gap fill and that's where it stopped with the flash crash. And I think those would be easy to manage. So if it keeps going down, I like selling the puts. Particularly, you want to always sell puts into down moves. That's when the IV gets jacked. Anyway, that's Tesla. The Apple, want to talk about some Apple. So on the stream yesterday, there's a lot of pessimism in Apple, which is great if you're bullish. The stock has been looking below 109, and it has not. Someone's defending 109. I don't know what's going on over there. It doesn't really matter at this point who it is. I have my suspicions about what's going on with it, but I don't want to speculate because I don't know that. But I do know that I did say that when we were much, much lower, it was almost near the lows, I said by my eye that I thought that the stock should be 107 and it was still in the 108s, and I said something's up. And the stock has done nothing but rip since there, and it was in 112s, probably going to 114 or 115. There's a 20-day, 50-day moving average confluence close to 115. It's like 114. Let's stretch this chart out a little bit. It's like what's going on here? Oh, it's actually not even as high. I thought it was higher. It's in the one. It can't be. That can't be. Yeah, it is. It's in the 112.92. So it's not as high. I guess it's come down. I haven't been paying as much attention. That is also the downtrend. I would condone that if you're looking for a right or right out type of a short. That confluence of the 20, 50, and the downtrend would strike me as a good right or right out short. If you get through there, it's going to 115 real fast, so you don't want to be, stubborn. You want to be quick. Like if it gaps there on a Monday, Apple likes to fill gaps, you have good trade location, and you just put your stop above there. So that's Apple. I do think that they're going to have a good quarter. I think their China numbers are fine. I think that a lot of this worrisome problem with Apple is sort of more cosmetic than factual. But I would, if, like I said, the last time Apple ran into earnings, it got smacked down. It'll probably be the same thing. Someone won't like something. The best case scenario would be the shake and bake, for it to fail there, come down, freak everyone out, maybe get 103, and then it's a buy. That, to me, would be the ideal setup in Apple. You want to see the shake and bake. Let's end on IBB, because that's been such an important driver to the market. You've had the Hillary Clinton statements, which just broke the head and shoulders pattern. So the news always sort of falls along the line of least resistance. IBB has been in some problem. I do believe that there is cyclical rotation out of these tech stocks, like the Facebooks, the Apples, the biotechs, the Biogens, which looks terrible. I'll talk about that in the weekend video. That looks like it could have another big leg down. And if that happens, it's going to pull down biotech. I think the ETF is sort of it's the tail wagging the dog here, that these ETFs have gotten so big that they wind up influencing the stocks themselves rather than the stocks influencing the ETFs. So it's been really in a bear flag pattern. It has been much weaker. The bounce has been much weaker than the broad market. It's just kind of hovering around these lows. And I think if you snap these recent lows here, there's like the 285s, 284s, I think it's going to have another leg down, and it could get kind of fugly pretty fast. I'll discuss that in the weekend video, though, because it's a little bit easier to discuss. If we do wind up rallying back up, maybe there is a downtrend touch, which would be a great opportunity for a right or right out short. My favorite of all of the biotech stocks, I've always liked Amgen, and I like Gilead. That's a big popular one. I would love to see them do something like miss the quarter and a gap down to 85, and then you sell the puts or you buy it. As crazy as it sounds, that was the flash. That was really the main breakout area. It was also the flash crash low. The stock is not cheap. Is very cheap based on earnings. The problem with only going by earnings is that stocks, when they look cheap, it's because they're at their cyclical peaks, that they look the cheapest because their earnings are the best, and it usually happens right before a downturn. I don't know if that's going to be the case with Gilead. Their earnings have been really fantastic. The last 2 quarters have been really big blowouts. I think I like that it's come down. I would love some shake and bake action in there before the quarter. We'll see what happens. But keep in mind, no matter how much you like that, if the IBB snaps, it's going to get shellacked just the same, because this is the tail wagging the dog here. Anyhow, I think we did a pretty decent job today. We've gone, I would have liked to have, I was joking around maybe a little bit too much. I like to make Friday maybe a little bit more lighter. But I assure you that we will cover the Netflixes and the wins in the weekend review video. I guess I could be a tease here if nothing else. If you're not following me, follow me on Twitter. My handle is @JustinPulitzer. If you missed or came into this late and you want to see it from the beginning, I will repost this on my YouTube channel. That's Justin Pulitzer Trades. There's a link to that, oddly, in my LinkedIn, not my LinkedIn. What am I talking about? LinkedIn. In my Twitter profile. So that is going to be, that's the story. Anyhow, that's my story. I'm sticking to it. Let's have a good weekend. It's going to be cold soon, so let's try and enjoy, I guess, the remnants of whatever this weather is. So, cheers.